It's narrative season. We get to
No.
hear all the narratives from all the people who want to sort of sell you on their positioning in the market, and it's just so much fun. I know you get a kick out of reading some of this stuff. I certainly do, and it's fun to sort of dissect these narratives and look under the surface. And today we're gonna take a deeper dive on some potential narratives we're seeing because we're hearing a lot of different narratives around the housing market.
Mm.
And it'd be cool for us to sort of dig into some of those narratives and talk about what we see in the data and start off maybe with some insights into consumer sentiment and confidence.
We can talk about one narrative that's reasonably hot right now, and it's around consumer sentiment, which we can show on this first chart here, the green line, which is actually lower than it was during the depths of COVID. Shocking, right? That consumers have worse sentiment now than when the entire economy was locked down and we were going into a global pandemic.
Yeah,
Um,
what do you think is the driver of that sentiment?
yeah, and the narratives that are being spun here, and if you look under the hood at the survey, a lot of what's driving this downturn in sentiment is inflation and buying conditions. Buying conditions, and then also um, the consumer sentiment survey has a much longer time horizon over which consumers are asked about how they feel about things. So they're thinking, up to 5 years in the future for some of the questions. So
Yeah.
this is more about, this is less about how you feel about things now and more about how you think in the future, how you think things are going to be in the future. So more about expectations. Another factor that's become very strong recently that goes into sentiment is the amount of political polarization we have. So you can break down consumer sentiment by political party. And what you find is basically for the last, 5+ years, half of the population has had a really negative view about the path of politics and what's going on in Washington. And that really drags down sentiment.
And how much of this sentiment drag is attributable to COVID and sort of case counts and that narrative?
Yeah, definitely in March 2020, that was the primary factor. And you saw another dip in sentiment related to the Delta variant, the spread of the Delta variant, and reinstituting mask mandates, vaccine mandates, things like that in sort of summertime to early fall of this year. So the COVID situation definitely plays into this because when you think about the crux of what consumer sentiment is, it's highly influenced by the media and what
Yeah.
you consume. And you know, a lot of news outlets follow if it bleeds, it leads. And
Right.
so you're just getting inundated by negative news, and there's plenty of negative news around COVID, obviously. So it is influenced somewhat by that, and now you have a lot of negative news and media about inflation and supply chains, and that's
Yeah.
factoring in. And there's never a shortage of vicious news articles about politics, and so that's factoring in as well.
So what's interesting about this chart is, so you just spoke about the sentiment factors, but there's a significant divergence between sentiment and confidence. So tell us about confidence and what that is representing here.
Yeah, confidence is it's a much shorter look into or time horizon around how consumers are feeling. And it's more related to their prospects for employment and their current financial situation. So that's, you see a lot of times these sentiment and confidence are similar, but then they do diverge. There are some time periods when they diverge pretty dramatically. This is one of the largest divergences between confidence and sentiment that we've ever seen
Hmm.
going on now. So the difference in the questions that are being asked and over what time period consumers are asked to discuss how they feel, that's one huge difference. Um, the other big factor is, you know, consumer sentiment, you can think about more expectations for the future. Consumer confidence, you can think about more your current situation. And what we see is that consumers' expectations for the future are actually rarely better than their current situation. It almost never happens.
Mm-hmm.
And this is almost by human nature.
Yeah.
So another way you could look at that, and we don't have it here, but the conference board who issues consumer confidence, this is the present situation index in the blue line. They also issue a future expectations index that has a much longer lead. And what you find is people almost always feel better about their current situation than their expectations for the future. Their fears almost are never realized, if you
Mm-hmm.
will, fears
Yeah.
of the future. It always ends up being better than they thought.
And confidence has been running significantly higher than sentiment for quite some time.
Yeah, definitely. Yeah. And you think about, jobs are plentiful,
Mm-hmm.
wages are going up, personal incomes have been running near all-time highs basically since the pandemic. Um, wealth is at all-time highs. So if you're asking a question right now or in the very near future, how do you feel about your personal financial situation and your opportunities for employment? You're probably going to get some good scores.
Yeah.
That type of a questionnaire versus, how do you think 5 years down the line, and then factoring in human nature, factoring in inflation, supply chain, what you hear in the media, you're probably going to get a worse answer.
Yeah, for sure. So let's take this information and translate it into probably the largest good that affects people's confidence or sentiment, which is the housing market, and
Yeah.
take a look at some of the data behind that and the narratives we're hearing. I mean, there's no shortage of stories on the housing market's going to crash. You see those regularly. Um, the data tells us potentially a very different story, and they don't write a lot of articles on the housing market's going to boom. I've found a few, but not relating to the crash. It's about 10 to 1. So let's look at the data though, and see how that translates in lines up with the sentiment and confidence
Yeah.
factors we just evaluated.
Yeah, this is a great exercise to really get under the hood. Just pick an item. So let's pick homes. So the blue line, that's a consumer confidence measure, and that's percentage of respondents that are planning on buying a new home in the next 6 months. And that is near all-time highs.
Mm-hmm.
So very bullish for the housing market, right? And this is in spite of the green line, which is the consumer sentiment measure that surveys people and asks, how do you think home buying conditions are currently? And that is the lowest level we've ever seen. So home buying conditions are the worst we've ever seen. And so this is a huge disconnect, right?
Yeah.
Everybody who responds to the consumer sentiment survey, if you look at how that survey is constructed, knows now is not a great time to buy a home because it's a very competitive market and prices are going up and have gone up quite tremendously. So the buying conditions, particularly related to price, are bad. And you know this even if you're not trying to buy a home. You know this just by reading news or getting out from underneath a rock, right?
Right.
And so that's what you get in consumer sentiment. Everybody's saying, I know this is a bad time to buy a home. But what matters is, are people actually going to buy homes? And they are. Because they have tremendous confidence in their current financial situation and they think, yeah, I know it's a bad time, but that doesn't change the fact that I want to buy a house in Texas or Florida or wherever it is,
Right.
right? And I have the money to do so. And I'm confident in my financial situation and my job prospects. So we put a lot more weight into confidence. It's
Mm-hmm.
kind of what you're gathering as we go through here, as opposed to sentiment.
Right. And this big divergence between sentiment and confidence, how does this sort of play out over the next 12 to 24 months? Like how do we factor this into potential housing forecasts?
Yeah, well, that's extremely interesting. For that, we like to look at people that are actually forecasting how many houses they can sell, right? People who are in this business, right? So it's great to look at the National Association of Home Builders.
Yeah.
Say
So
how confident are they? They're looking at all these charts as well, right? And they're doing it on a daily basis. So
yeah.
that's on the next chart.
Yeah, and explain the National Association of Home Builders and what their survey is, so people can get a baseline understanding here.
Yeah, so on a monthly basis, home builders are surveyed and basically asked how do they feel about three various measures. One is the present sale conditions. So your your ability to sell new homes in the current market environment. And that gets scaled from 0 to 100. So right now we're at 89, extremely bullish. Home builders say, hey, I can sell houses right now. How do you feel about future sales in the next 6 months? This relates very closely to that consumer confidence home buying plans next 6 months that we saw in the prior chart. So that's the green line. That's also very high, 84. And then the last is the blue line. How do you feel basically about like traffic and prospective buyers? How big is the pipeline? How big is your potential order book, right? And that's also very high at 68 out of 100. So, the folks that get paid to forecast demand for housing and are in this business every single day are also very confident about their ability to sell new homes.
Yeah.
So we would also put more weight in that than we would a consumer sentiment metric that shows now is the worst time to buy a home ever in the history of the survey.
Yeah, all these levels are at or near or above all-time highs on this chart. I mean, they're all accelerating to the upside. So there's obviously some regional bias here. Can you speak to sort of how that plays into these numbers?
Yeah, the regional bias that is also partly seasonal. So generally speaking, home builders, when you ask them how do they feel about their ability to sell homes in places like the Northeast or the Midwest as we go into the winter, it falls a little bit. But we have been, at or near record highs for places like the South and the West for quite some time, basically since COVID happened. So there's definitely regional biases here.
And just sort of the high frequency data points. I mean, I think the data we got for October, permits were up month over month, almost 5%. So you're seeing acceleration in this data from sort of the summer months where things were sort of bottoming out, perhaps.
Yeah, definitely.
Yeah. So we would expect this data to continue to accelerate. What do we think in terms of the housing market look for next year?
Well, if you think about how the home builders are thinking about this, and they say, yeah, we have supply chain problems. Yeah, our input costs are rising. But we are in no real hurry to, and we really can't, flood the market with supply. It's just not going to happen. Even if we wanted to, we don't have the labor, we don't have the inputs. So we're going to take our time. We're going to make sure we preserve our margins, and we're going to add supply very slowly. And we just talked about the entire demand side of this equation. People still want to buy houses. They have plans to buy houses. Wealth is high, job market is strong, wages are up. People want to relocate post-COVID, and people are retiring early at a rapid clip. The demand side looks like it's going to be strong. And we're basically saying that the supply side, we can't flood the market with supply of new homes. So what that means for prices is they're probably going to continue to go up, or at least have upward pressure when you think about the two components, the supply and demand, for at least the next 12 months.
Yeah. And so what's the unknown that could affect the housing market in the next year or so?
Yeah, the biggest known unknown in our view is a sort of dramatic decline in the value of financial assets. That would probably be the biggest thing. And it's not just for housing. It would really be for everything.
Right.
Wealth is at all-time highs. The wealth effect has never been higher. And so, a lot of folks, if you saw the value of the stocks in their portfolio, or even their crypto assets or their home, if that were to fall 10 to 20% because of something like a big policy mistake by the Fed, rapidly rising interest rates, some geopolitical risk that came out of nowhere, that would dramatically reduce people's plans, in our view, dramatically reduce people's plans to buy new homes.
And so other factors like inflation or increase in COVID case counts, lockdowns, anything in that realm potentially affecting housing?
Yeah, so those things in isolation, we know COVID hasn't really affected the housing market at all. If anything, it's been a catalyst to get people to move.
Yeah.
So we would say that probably would not have a negative impact. That almost can only be positive. And then in terms of inflation, what we've seen is through these charts, as long as people have the money to afford the house, then they're going to do it. They're going to buy the house. So you would worry less about the inflation side. You would have to see something really, really scary in order for house prices to go up so much that all of a sudden, even when people are very wealthy, they decide they can't afford the new house, basically before they get priced out. We're pretty far away from that.
Yeah.
So inflation on its own, probably not. But if you had prices continue to go up dramatically while wealth was declining, that could definitely cause a problem.
Yeah. And how about fiscal potential for fiscal stimulus to either fall off or increase?
Yeah. Well, what's already baked in the cake is the assumption that fiscal spending year over year is going to decline. I mean, we had massive fiscal spending in 2020 and 2021 related to the pandemic. And so now we don't need those types of emergency policies and things like stimulus checks. So the year over year change in fiscal spending is going to be negative. It's going to be a drag on economic growth. But that's already baked into expectations, right? So what you're running into is this base effect year over year. We came off a real high spending spree, fiscal spending. So next year it's going to be lower. So the base effects are tough. But you're also running into something called the ratchet effect, which is this phenomenon whereas particularly after a crisis, governments and policymakers have a tendency to continue to ratchet up their spending for an extended period of time, even after the crisis is long gone. And so we think that's what's being underappreciated here. I would not be surprised at all if we were to see if we were to see a slowdown in economic growth next year. Would not be surprised at all if it was met with more fiscal stimulus very quickly.
Which would be very supportive of an upside to the housing market, correct?
Yeah, for sure.
Yeah. So I guess when we think about these narratives, just always sort of come back to the data, because that's really where you can sort of tell your story, and everyone's got a narrative, and usually they have a reason for their narrative because they're trying to sell their book or position their book. So any final thoughts on the housing market?
I just say, as you were saying, you probably get way more clicks, likes, and views for just spinning a negative narrative, and we're probably proof of that because we don't do that. So,
yeah, that's for sure. So, well, that's been a great insight. Thanks to our research team for pulling up these charts, and there's a lot of information in here. And housing's a big important topic, so we'll definitely be coming back to this and talking more about this in our outlook for 2022. So stay tuned for that. And Mike, thanks for joining us today.